Hello and welcome to this monthly fixed income outlook where we try to decipher what is the inference for global and domestic fixed income developments that have happened over the last 1 month and what it means for the investors. So for this discussion, we have with us Mr. Basant Bafna. He's head of fixed income at Mirae Asset Mutual Fund. Welcome, Basant.
Thank you.
So, Basant, my first question to you would be, it has been more than a month with the Iran conflict, and we are yet to see the end to the war. An important development which has happened recently is the announcement and approval of Hormuz toll plan. From India's perspective, I think this is an important development. How do you see? What is your view on that?
We discussed in our previous conversation that in case this conflict escalates for more than 3 weeks or so, the volatility for markets may be significant. That's exactly what has happened. The escalation has moved beyond the 3-week threshold, and because of that, the supply cuts on account of the Strait of Hormuz for the globe, it has exacerbated significantly. While the toll plan has been announced, there have been some developments on that account. So, first is in terms of the ability to transit through the Strait of Hormuz, Iran has announced friendly nations versus non-friendly nations, and India is a part of the friendly nations pack, and those friendly nations are being permitted to use the Strait of Hormuz for its requirements. Secondly, there was one very interesting development as well on Malaysia, that Malaysia has been permitted to transit through the Strait of Hormuz without paying off any toll. While for the other friendly nations, there is no clarity as such whether the passage would allow to be done toll-free or not. But nevertheless, in terms of supply disruptions, this is a significantly positive development.
So there are rising concerns over fiscal slippages due to the recent announcement as far as excise duty cuts on petrol and diesel is concerned, as well as subsidy on fertilizers. So what is your thought on that?
So in terms of the excise duty cuts, on an annualized basis, the impact is in the range of close to 0.45 to 0.5% of GDP. In addition to that, there would be some tailwinds as well with regard to the ATF export duty rises. So overall, if this conflict continues for say a quarter or so, the overall impact on fisc may be in the range of 0.1 to 0.2% of GDP.
So, Basant, RBI recently released the GSEC government borrowings for the first half of FY27. And like last few years, the trend has been more skewed towards 10-year and below 10-year kind of segment. So from a yield curve perspective, what are your thoughts? And in terms of OMO purchases like last year, do you see similar kind of OMO purchases from the RBI to manage the supply side pressures as well as manage liquidity?
Sure. So in terms of the overall borrowing program, this is exactly what the markets had asked for. So the supply over the last few years has consistently been skewed towards the longer end. And the ask by the markets was that the overall calendar be tilted away from the 15-year and plus duration for borrowings. So with that, that remains a positive development for markets because the appetite for long-end securities has been significantly limited. As you are aware, a large part of the heavy lifting in terms of the OMOs has been undertaken by RBI over the last year. So close to 8.5 lakh crores worth of OMOs have been undertaken on and off screen. With this year, while the overall positioning remains significantly light, but I think RBI will need to continue to do a lot of heavy lifting this year as well. In terms of the overall requirements, I think perhaps CIC leakages this quarter would be in the range of 2.5 lakh to 3 lakh crores, which would necessitate some form of OMOs, as well as to support overall markets. I think the expectation should be broadly in the range of 2.5 to 3 lakh crores worth of OMOs as a bare minimum that markets would expect. and perhaps to give a lot of comfort to markets, I think the numbers that we are looking at is close to 3.5 lakh crores.
Basant, over the last 1 month, what we've seen is yields across the curve have hardened significantly. It has been a combination of two factors. For the short end, it has been liquidity, which has been due to seasonal tightening that we usually see closer to the financial year end. And the other is on the supply side, the longer yields have hardened because of what we are seeing on the West Asia conflict front. So, in a combination, do you continue to remain positive on the 1 to 3 year segment, or are there any changes to that?
So, with the recent rise in conflicts, the yield curve has bear flattened significantly, and I think we've come to a situation wherein you are actually throwing the baby along with the bathwater. And I think given that the inflationary concerns, even if the conflict say lasts for this quarter, oil perhaps moves towards $140 a barrel, still the annualized impact would be close to 200 basis points at the maximum, which essentially means that the 1 quarter impact would be closer to 0.5%, which takes your FY27 inflation to 4.5%, which is significantly within the overall band of RBI in terms of the inflation targeting mechanism. Whereas if you look at the situation globally, I think it's quite different, wherein developed countries, they have significantly overshot their inflation as compared to the targets. So from a growth, inflation, evolving developments perspective, I think growth would start taking precedence. So you have an RBI policy as well this month. I don't foresee any hawkishness in the overall statements. The focus, I think, perhaps will be towards liquidity driven transmission, and with that OMOs come into the picture, as well as continuous infusion of liquidity to ensure that the system requirements are duly met. The other thing is that in terms of developments in the rupee that has happened with the net open position guidelines that have been revised, as a short-term measure also, it should provide a significant amount of relief to the rupee depreciation pressures. While we continue to look out for flows in terms of developments, but overall, I think we are going to be in a situation of a liquidity-driven curve steepening going into this quarter. While overall fiscal dynamics continue to remain under pressure, that would perhaps impact the longer end of the curve and not the shorter end of the curve. And therefore, our earlier view continues to remain intact, that the shorter end of the money market curve as well as the duration curve, so up to 3 years, still looks extremely attractive. A sell-off has now made it more attractive. So from that perspective, our view remains intact. And the curve still provides good opportunities for investors to lock in the yields.
Sure. Thank you, Basant. Thanks. As usual, it has been a very insightful session. Hope our viewers would have benefited from this. Thank you. Happy investing.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.